Well, we're learning quickly that the market has a lot more control of the 10-year than most investors thought. They've been treating the Fed as though there's some omnipotent ship captain on the open seas. And the reality is on the short end of the curve, they control short-term monetary policy. But the long end of the curve, the market controls a lot more. And, most of the reason for people owning stocks right now is that it looks historically terrible, but bonds look so much more terrible that stocks look pretty dang good. And I find both of the arguments really tough to swallow.
A sense of where you think our audience should be positioned at the moment, given the choppiness and the volatility that we're now seeing around both bond and equity market positions?
That's a great question. To your point about the bond market, this is going to be a fits and starts game. I mean, we spent 40 years finding an all-time low, and it's going to be a fits and starts game. Bill Gross, I think in the last week, had kind of commented on the nature of that. So do I expect bond investors to lose money? Yes. Back to what Karen was saying about the Berkshire letter, Buffett intimated that in his letter. He didn't go as far as telling people how bad it could be, but he said they're terrible investments in effect. On the stock market side, the real question, I think, for investors is, as the economies of the world, or using the United States economy, as it makes a comeback due to the success of the vaccination and the strengthening of the economies, does a business benefit from the factors that win in that scenario versus how that affects the price of money and thus the attractiveness of stocks? And that dichotomy of the economy winning and the stock market losing, I don't think investors have their minds wrapped around that at all.
Yeah, good morning to you, Cole. Very nice to hear from you. Look, we're only back to levels on the US Treasury, and I'm looking at my chart on the screen now, that where we were just over a year ago, at the start of 2020. That doesn't sound a very high yield to any of us who have been around a significant period. In fact, if you go back to the middle of July 2018, for instance, you get over 3%. If we're having this kind of wobble on markets when we get to 1.5, what are we going to be like if actually we do get some real momentum in the underlying economy, which I sorely hope we do?
Yeah, it's a great question. I'll give you one more thing to add to that, Steve. I'm 37, and most people at my age have never seen a nasty bear market in their life. They hardly could catch their breath in the spring, but have never seen really terrible equity markets and have never seen bonds lose money, to your point. And so I think most investors are just not prepared for this because, dogs chase cars and people chase stocks. It's just the nature of the beast. And therefore, they're not very prepared for this. And, what I tell people often right now is market risk looks terrible, but investment risk looks wonderful. In other words, we're buying malls, for example, here in the United States in Simon and Macerich, and we're buying them for less than the cost of replacing the assets. Well, that's just a very different conversation than saying, well, what are the S&P earnings going to be next year? And only God knows what someone's going to pay on a valuation basis for those earnings. I think the detachment of the S&P 500 to the tangible or intangible assets today, there's no relationship between those assets and the price of stocks as it pertains to the market. And I think that's where the damage of stocks will come. If people wake up to that, you could see quite a bit of hell and pain being handed out over the next 2 to 3 years.